What if I told you that the financial advice you scrolled past this morning while waiting for your coffee could legally be considered fraud if it came from a licensed professional? You have probably spent over 400 hours this year alone watching finance TikToks. You have watched 20-somethings in rented Lamborghinis tell you how to escape the matrix. You have watched day traders promise you can turn $500 into a down payment by Friday. And you have watched real estate gurus tell you that buying a duplex is a guaranteed path to passive income. But here is the terrifying reality that nobody on your For You page is talking about. A bombshell new study just exposed the dark underbelly of FinTok. Researchers analyzed the most viral financial videos on the platform, and the results are enough to make your stomach drop.
70% of them are actively misleading you. Only 10% pass the test for basic financial accuracy. If you are taking your money advice from a 60-second vertical video, you are not investing. You are gambling with your future, and the house always wins. Today, we are going to rip the mask off the FinTok industry. I am going to show you exactly where these viral gurus are lying to you, the psychological traps they use to bypass your critical thinking, and the real, unsexy truth about building wealth that the algorithm will never show you. Let us start with the data, because numbers do not have an agenda. The study conducted by daytrading.com set out to answer a simple question. Is the financial advice on TikTok actually safe for the average consumer to follow? They took the most viral, highly engaged finance videos on the platform and graded them like a high school exam. They looked at accuracy, risk disclosure, and the dangerous trend of oversimplification. The results were catastrophic. 60% of these viral videos earned a D or an F when it came to oversimplification. 40% scored a C or a D on pure factual accuracy. Think about what that means. If you went to a doctor and they gave you a medical treatment plan that was wrong 40% of the time and dangerously oversimplified 60% of the time, you would sue them for malpractice. But on TikTok, we give them millions of views, sponsorships, and our hard-earned capital. Why is this happening? It comes down to the fundamental difference between a fiduciary and an influencer.
When you sit down with a certified financial planner or a registered investment advisor, they are legally bound by the SEC and FINRA to act in your best interest. They have to disclose risks. They have to understand your specific tax bracket, your time horizon, and your risk tolerance. If they lie to you, they lose their license and face federal penalties. A FinTok influencer has no fiduciary duty. Their only boss is the algorithm. And the algorithm does not reward nuance. It does not reward the phrase, "it depends on your individual tax situation." The algorithm rewards absolute certainty, high emotion, and get-rich-quick dopamine hits. It rewards the guy screaming that the stock market is about to crash, or the girl whispering that she found a secret crypto coin that is going to do 100x.
Let us break down the first and most dangerous category of FinTok lies, the day trading and options illusion. You have seen these videos. A young guy sitting in a gaming chair, pointing at a chart with a dozen colorful lines on it, telling you that if you just learn his simple 3-candlestick strategy, you can quit your 9-to-5. What these videos conveniently leave out is the statistical reality of day trading. Study after study from universities and brokerages shows that over 90% of active day traders lose money over a multi-year period. The ones who do make money are usually the ones selling the courses, not the ones trading the charts. But the FinTok gurus completely ignore risk disclosure. They will show you a screenshot of a winning trade where they turned $1,000 into $3,000 in an afternoon. What they do not show you is the previous 14 trades where they blew up their account. They do not show you the pattern day trader rule that requires you to have $25,000 in your account just to day trade legally in the US. They do not explain the tax implications of short-term capital gains, which are taxed as ordinary income, completely eating into your already razor-thin margins. They are selling you the dream of easy money, but they are hiding the mathematical certainty of ruin. When the daytrading.com study graded these videos on risk disclosure, they failed miserably. They are handing a loaded financial weapon to teenagers and young adults who think trading 0 days to expiration options is just like playing a video game. Then we have the second massive pillar of FinTok misinformation, the real estate hack. Real estate is a fantastic vehicle for building long-term wealth, but the way it is portrayed on TikTok is a masterclass in dangerous oversimplification. You have probably heard of the BRRRR method: buy, rehab, rent, refinance, repeat. Or the concept of house hacking, where you buy a multifamily property, live in one unit, and rent out the others so your tenants pay your mortgage. In a 0% interest rate environment in 2020, this math kinda worked. But we're in 2026. Interest rates are fundamentally different. Property taxes have skyrocketed. Insurance premiums in states like Florida, Texas, and California have doubled or tripled. Yet the FinTok real estate gurus are still using 2021 math. They will tell you to buy a duplex for $400,000, put 5% down using an FHA loan, and claim that the rent will cover the mortgage. What they fail to mention in their 60-second video are the closing costs, which can easily eat up $10,000 of your cash. They do not mention the capital expenditures reserve you need for when the roof leaks or the HVAC system dies. They do not factor in a 10% vacancy rate because tenants move out and properties sit empty. They do not mention the nightmare of property management or the fact that being a landlord is not passive income. It is a part-time job dealing with clogged toilets and late-night emergency calls. By oversimplifying the math, these influencers are pushing their followers to over-leverage themselves into properties that have negative cash flow from day one. When an unexpected repair hits or a tenant stops paying, the passive income dream turns into a foreclosure nightmare. The third trap is perhaps the most predatory of all, the crypto and altcoin moonshot. This is where the line between financial education and outright market manipulation completely disappears. A FinToker will post a video with a shocked face pointing at a green arrow, talking about a hidden gem microcap cryptocurrency that is about to explode. They use buzzwords like Web3, decentralized finance, and asymmetric upside. What they are not telling you is that they bought that token 3 weeks ago when the market cap was practically zero. They are using their millions of followers as exit liquidity. In the financial industry, this is called a pump and dump, and it is highly illegal. But on TikTok, it is just sharing my portfolio. The study highlighted that crypto videos had some of the lowest accuracy and risk disclosure scores of any category. They do not tell you about the liquidity risks. They do not tell you that if you try to sell your bags, the slippage might wipe out 50% of your value. They do not warn you about smart contract vulnerabilities or the fact that the developers can literally rug pull the project and disappear with the liquidity pool. They are playing a game of musical chairs with your life savings, and they already know where the only safe seat is. And then there was the credit card churning and debt hack category. On the surface, this seems harmless. Influencers showing you how to get free flights and hotel stays by signing up for premium credit cards and hitting the minimum spend. Or they show you hacks to lower your credit utilization by opening new cards. But the oversimplification here is lethal for anyone who does not have perfect financial discipline. The credit card companies are not stupid. They offer these massive sign-up bonuses because they know the data. A significant percentage of people who open these cards will eventually carry a balance. And when you carry a balance on a card with a 25% APR, the points you earned are entirely wiped out by a single month of interest. Furthermore, constantly opening and closing credit accounts can severely damage the average age of your credit history, which is a major factor in your FICO score.
The influencers get a kickback from the affiliate links when you sign up for the card. You get a free flight. But if you slip up and carry a balance, the bank makes thousands of dollars off you. The FinTalker is acting as an unpaid marketing arm for the very institutions that profit from consumer debt. So, if 70% of this content is trash, what does the 10% that actually gets an A grade look like? The study found that the creators who actually passed the test shared a few common traits. First, they embrace the boring. They do not promise that you will be a millionaire by 25. They talk about the slow, agonizingly boring process of maxing out your 401k, getting the employer match, and buying broad market index funds. Second, they use the most powerful phrase in personal finance. It depends.
They acknowledge that a Roth IRA is great for a young person in a low tax bracket, but might be the wrong move for a high-earning physician who needs the upfront tax deduction of a traditional IRA. Third, they cite their sources. They reference the IRS tax code, historical data from the S&P 500, or studies from the Bureau of Labor Statistics. They do not just say the market always goes up. They show you the rolling 20-year returns and explain the sequence of returns risk. These creators do not go as viral as the guys screaming about the impending doom of the US dollar, but they are the ones actually helping people build generational wealth. This brings us to the psychological trap that keeps us watching the bad content. It is a dangerous combination of the illusion of competence and the Dunning-Kruger effect.
The Dunning-Kruger effect is a cognitive bias where people with low ability at a task overestimate their ability. In finance, this is lethal. When you watch a 60-second video explaining a complex macroeconomic concept like the yield curve inversion or quantitative tightening, your brain releases dopamine. You feel like you learned something. You feel financially empowered. You suddenly think you can predict the Federal Reserve's next interest rate hike and time the stock market perfectly. But watching a video about working out does not build muscle, and watching a TikTok about options trading does not make you a successful investor. The FINRA Investor Education Foundation regularly conducts studies on financial literacy in America, and the results consistently show that while people feel more confident about their financial knowledge, their actual tested literacy is dropping.
Social media is creating a generation of highly confident, financially illiterate investors, and the market is a brutal teacher that charges expensive tuition for arrogance. Furthermore, look at the Dalbar quantitative analysis of investor behavior. This study has tracked how the average investor performs compared to the S&P 500 over the last 30 years. Consistently, the average investor underperforms the market by a massive margin. Why? Because they try to time the market. They buy when the media is hyping a bubble, and they sell in a panic when the market corrects. FinTok acts as an accelerant for this terrible behavior. When the market is at all-time highs, FinTok is flooded with videos about how we are in a new paradigm and you need to use margin to buy more tech stocks. When the market drops 10%, the algorithm pushes videos of guys in bear costumes screaming that the Great Depression is back and you need to sell everything and buy gold. If you follow the emotional pendulum of your For You page, you are mathematically guaranteed to buy high and sell low. The FinTok algorithm preys on your financial anxiety. You are worried about inflation. You are worried about housing prices. You are worried about AI taking your job. The algorithm senses that anxiety and feeds you a simple, actionable solution like just buy this coin or just use this real estate hack. It gives you a false sense of control over a chaotic macroeconomic environment. You spend 400 hours a year consuming this content, and at the end of the year, your net worth has not changed, but the influencer has bought a new mansion. You have traded your most valuable asset, your time and attention, for the illusion of financial progress. We also need to talk about the regulatory gray area that allows this to happen.
The SEC and the FTC have started cracking down.
They have issued warnings about finfluencers failing to disclose paid promotions. They have fined individuals for giving unregistered investment advice. But it is a game of whack-a-mole. For every influencer the SEC finds, 10,000 more pop up using coded language to avoid triggering the regulators. They will say, "This is not financial advice. This is just my personal opinion," and then proceed to tell you exactly what ticker symbol to buy and at what price. That disclaimer does not protect you. If you lose your life savings following their opinion, you have zero legal recourse. You can't sue a TikToker for bad financial advice. You are entirely on your own. So, how do you protect yourself? How do you curate a financial diet that actually serves you? You need to implement the FinTok Filter. Every time you see a piece of financial advice on social media, you must run it through 3 brutal questions. Question number 1, what is their incentive? Are they selling a course? Are there affiliate links in their bio? Are they trying to pump a token they hold? If they are making money off your click, their advice is compromised. Question number 2, where is the nuance? If the video presents a financial strategy as a guaranteed risk-free way to make money, it is a lie. Every single investment vehicle in human history carries risk. If they do not spend at least half the video explaining the ways you could lose your money, click away. Question number 3, is this scalable for a normal person? If the strategy requires you to stare at 6 monitors for 12 hours a day, or requires you to take on massive amounts of high-interest debt to work, it is not a wealth-building strategy. It is a high-stress job. True wealth building is not a hack. It is not a secret loophole that the government is hiding from you. It is the result of a mathematical formula that has worked for over a century. Spend less than you earn, invest the difference in diversified, low-cost assets. Let compound interest do the heavy lifting over decades. It is boring. It will not get you 1 million views on TikTok. It will not get you a sponsorship from a crypto exchange. But it is the only strategy that has a near 100% success rate if you stick to it.
The financial industry wants you to believe that investing is a casino because casinos make money on the churn. They want you trading, buying, selling, and paying fees. But the real money is made by sitting on your hands and letting American enterprise grow over time. You have to realize that your attention is the most valuable currency you have. Those 400 hours you spend watching FinTok could be spent reading a foundational book on investing, like The Psychology of Money or A Random Walk Down Wall Street. It could be spent learning a high-income skill that actually increases your primary earning power, which is the most potent wealth-building tool you possess. Stop looking for the shortcut. The shortcut is a mirage designed to sell you water in the desert.
The next time you open TikTok and see someone promising you the secret to financial freedom in under a minute, remember the data. Remember that 70% of them are failing the most basic tests of accuracy and risk disclosure. Protect your mind, protect your capital, and refuse to be exit liquidity for an influencer's lifestyle. If you are tired of the noise and want to understand the actual mathematically proven way to build wealth without the gimmicks, you need to watch this video right here, where I break down the exact, boring, beautiful index fund strategy that has quietly created more millionaires than any day trading scheme in history. Click right here, and I will see you in the next one.